This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast and subscribe. Well, we've got a good show for you today. This is an area that we're going to be talking about as one of the key areas for those of you guys, especially that are in multifamily out there. It's the whole idea of underwriting. But we've got an expert here who is sort of the king of underwriting for multifamily deals. And his name is Omar Khan. And Omar is responsible for capital raising, strategic planning, and investor relations for Boardwalk Wealth, a private equity firm located in Dallas, Texas. Boardwalk Wealth connects international investors with U.S.-based multifamily real estate opportunities with their unique focus on helping Canadians identify ideal commercial real estate opportunities in the southern United States. They offer access to premier partners with a track record of large-scale investment, best-in-class property managers, and tax and law specialists in foreign investing. Omar has over 10 years of global investment experience across real estate and commodities and has advised high net worth individuals and entrepreneurs on real estate portfolio allocations. He has participated in capital financing and M&A transactions valued at $3.7 billion and syndicated multi-million-dollar deals across the U.S. He is a CFA charter holder and graduated with honors from the University of Toronto with a BCom in finance. Omar moved from Canada and now lives in the Dallas, Texas area with his wife and newborn son. Well, Omar, welcome to the Old Dogs REI Network.
Thank you, Bill. I feel like you've done such a good job introducing me that we should just end the interview right now on a high.
I think I pretty much said it all, so yeah. I think that's pretty much it. Are you ready to do your closing howl now?
Yeah. No, actually, fun fact, Bill's got a great howl. Listeners, we were just talking about that before we started.
Well, it's great having you on, Omar, and this is a great area. I think we're going to talk a lot about your investing experience as well, but I really want to zero in on the whole idea of underwriting, looking at property, especially now in an area where we're, right now an economy where we're approaching a market correction or maybe another recession, whatever may happen, the underwriting is even more critical, I think, now than ever. So I'm real interested in hearing your thoughts on that. But before we get started, I just want our listeners to know a little bit about you. I mean, granted, I kind of gave a little diatribe there.
You gave everything away, Bill. There are no secrets anymore.
You can tell us, the stuff, that I didn't talk about. The real behind the scenes story here. So,
well. I'm from Pakistan. Rather, my family's from Pakistan. I grew up in a combination. I was born in Dubai. I lived in Pakistan, Toronto. Most of my childhood, I kind of went back and forth between the U.S. because my family is a business family. So my dad was doing some work with, do you remember Magnavox, that old company?
Oh, yeah.
Right?
Gosh.
So the Department of Defense had a lot of satellite and that sort of work in the Middle East and Pakistan, India. So my dad was working with them as a business guy. So I kept shuttling back and forth. So yeah, I mean, I spent parts of my childhood in very different locations. But the story that Bill really wanted you guys to know is that how did I decide to go to Canada? And how that happened is that I went to a nice private school, and when it came time to decide, okay, which universities you got to go to and all that stuff, right? I just wanted to pick a place on the map that practically nobody from my school was going to. And everybody was going to the US, Australia, England. A couple of guys went to Germany and Hong Kong. And coincidentally, right around that time, I had read a UN report. I don't know how I read this report, no idea how or why, which said that, hey, in 100 years, the scarcest commodity on the planet is going to be fresh water. Okay? And I was not a prepper at that time, and I'm still not a prepper yet. But then I read, and they coincidentally said in the report, but by the way, 80% of the world's fresh water supply is in Canada. And nobody was going from my school to Canada. So I thought, okay, nobody from my school is going to Canada, and they've got all the world's fresh water. So, worst comes to worst, I'll at least have water to drink. And that's how I moved to Canada.
I love it. So your real estate must have started, buying like an underground, little
bunker
that you would live in, right? Off the grid and and all the water you could possibly consume.
Yeah, I wish, but real estate prices in downtown Toronto are so expensive that, I would have to sell both my kidneys to even afford like a small bunker. So I wish I started, but that's not. How it started is my family owns a lot of commercial property, retail centers, one or couple of small, those low service hotels, motels sort of things, and a bunch of other small little things around the time. And frankly, hardly any residential real estate, which now that I think about it and I talk to people sounds really weird because everybody says, hey, we own real estate, but it was all houses. And my family was all in commercial. That wasn't their business. That's just where they parked their money. So growing up, I just kind of had heard my dad, my uncles kind of talk around the, dining table. Hey, we've got this tenant. He's a lower quality tenant, credit tenant, but he can pay more money versus a more national tenant who can pay slightly less money, but is a better tenant, all those sorts of things. You go to a site, you want to refurbish actually your retail strip center. You kind of talk to GCs and all that kind of stuff. So all those conversations I'd kind of grown up around. And my dad's, he's an engineer, but he's got a finance background as well. So I kind of had seen that the actual going to the site and talking to people, plus also the financing portion of it. So it wasn't by some grand design. It was just a process of osmosis that I'd taken a lot of these things in growing up.
Now, were these properties located in Canada or U.S.? Oh,
Pakistan, and a couple of them were in the U.S.
Oh, wow. Okay, so internationally then. Okay, awesome. Now, yeah, your background definitely looks like it leans very much to the finance side of things, right?
Yeah, because when I was going to college, I decided, Bill, if you look at me, I'm real thin. I don't work out, so obviously physical labor was out of the question. If you look at my hands, they're really nice, soft hands, man. So I thought, okay, what's a good fit for my background? And what kind of interests me? And honestly, I did not want to do accounting. I've done a lot of accounting, coincidentally. So finance was a good option. I just knew a lot of people in finance. My dad was also in finance. It was a good fit. I did it. I'm very happy that I did it now that I look back. But again, a lot of these things, no grand plan. You just kind of fall into things, and I guess there's a plan by God, but I don't really know.
Interesting. So did you start investing as more sort of a passive investor? Because I see you had the sort of the financial planning sort of experience, or were you buying properties? How did you start off in real estate?
Well, directly through our family's portfolio, I was investing directly because, my name is on the trust and all of that sort of stuff. So whenever we'd buy it, all that jazz, all that estate planning and all that stuff. And then when I moved and I was kind of managing small bits of money up north in Canada for private individuals and some family and friends. And when we moved down actually 3 years ago to the U.S., Texas specifically, we just started looking around because a lot of folks told us, hey, you're moving to Texas. We've got a couple of assets here. You want to have a look? Can you help us structure these, get some of our money out? Because some of our family friends, they'd bought a lot of office properties in Houston. And now, as they were getting older and now they had their kids, they're older now, and they want to pass it on to the next generation. You kind of want to do it in a tax efficient manner. I mean, it's really boring, don't get me wrong. So I just kind of went down, kind of helped them out, and started looking around, talking to people. I had a background doing all these things because I was doing a lot of this stuff institutionally, and that's one thing led to another. But just because of my background, because of my track record, and because of my family, it was a slightly smoother entry point than if I just kind of picked this up and started reading a book and then going from there.
Gotcha. And so, dealing with property, sounds like you grew up, in at least the understanding of what goes on, both from a management. Now, were you actually involved in sort of analyzing any of your family properties as well, or were you more active in sort of the management, the asset management?
It was more along the asset management side, because by the time, I mean, let's put it this way. My family did not give me that much importance, Bill, to make these kind of decisions for them.
Mm-hmm. Got it.
So just I was also responsible for advising, and now when I graduated, I had all this institutional experience at big broker dealers doing the CFA and everything. I could then advise them on structuring and all of that stuff. But hey, man, the guy, he who pays the piper gets to call the tune, and I was not paying the piper. Somebody else was. My dad, not me.
Gotcha. Well, it sounds like you definitely got your experience, though. I mean, participating in capital financing and M&A transactions, over $3.7 billion. Now, was that in the company that you're currently with, or was that prior to Boardwalk Wealth?
Within Boardwalk and prior companies as well. So my work was both in oil and gas. I've also done asset management on the institutional side, and now Boardwalk Wealth. It's a combination of all of it.
Gotcha. But now it seems like if I read it right about the company, it sounds like it's all focused primarily in multifamily. Is that correct?
Oh, yeah.
Talk about that. You've got this broad background. It includes a lot of different types of commercial and I guess things outside of real estate as well. Focusing on multifamily, was that a conscious move for you?
Yeah, yes, in the sense that, Bill, my wife's a physician, so she makes, thankfully, she makes good income. I've been blessed to be in a position to make a reasonably good income. So from a family perspective, we were basically looking not just to make more income, but also to protect, or I guess protect is the wrong word, to basically make sure that we paid the least amount of taxes. That's the frankest way I could tell you that.
Gotcha.
And just the way with so many moving parts in multifamily, we could basically do a lot of strategies like cost segregation, accelerated depreciation, all that kind of stuff, 1031s, all of that. So that really encouraged us. But the other deal also was leveraging our experience and background. We could actually scale up our operations, right? Because, look, it could just be me and my wife, and we could start buying houses and then slowly start scaling up over a period of X number of years. But just given our background and access to some of the networks, we could basically get into bigger deals quicker, going the multifamily and commercial route.
So you personally are also acquiring properties then for your family, right?
Yes, but now it's all being rolled into this private equity thing. So now, for instance, we're investing alongside our investors.
Okay, got it. All right. And so you're active and passive then, it sounds like, right?
Yeah.
So you're part of syndications as well as buying actual real properties on your own too.
Oh,
right?
yeah. So for instance, when we're guaranteeing the debt, right? I mean, my name is on the debt, right? So basically, I'm taking all the risk as a general partner.
Right.
But then a portion of the money that we're investing personally, that's through the LP structure as well, right?
Gotcha. So you'd be considered a sponsor on some of the deals that you're doing? Okay, got it. Okay, so you come at it from very different angles. It's interesting too that, out of all the investments out there, that real estate had all that you were looking for in terms of returns and tax
shelter
advantages as well, right? Yeah, right.
Yeah, Bill. And this weird thing, I was actually joking to a friend of mine. He's in technology in the Bay Area. I think it's really weird if you have an idea and you want to go raise money for what could be a really great world-changing idea. You're going to have a really, really, really hard time raising money for that because people like proof of concept and all of that stuff. But what it's really weird, and I've discovered this coincidentally, I guess, is that if you try to raise money for real estate, and if you've got a good track record, man, it's way easier raising money in real estate than any other industry I've worked in.
Interesting. Really?
I don't know why that is. Maybe I think it's the fact that people it's a tangible asset, right? You can, the touch, feel, you can actually physically go visit it. So I think maybe that's the thing, and maybe people are more inclined towards investing in real estate versus, say, things like technology, where you can get a way higher multiple on your money, but it's kind of an intangible concept, right?
Right. Yeah. And I mean, you were dealing with, you said oil and gas at one point or something too?
Yep.
I mean, okay. So that, again, I guess you could say that's somewhat tangible, but
It's also kind of intangible because you never really see the oil.
yeah, right.
about it,
Exactly. And you don't always know it's going to be there or it's there. I mean, there's a lot of variables, right?
In fact, most times it's not there.
Wow. In doing this, too, investing specifically, and it's interesting. I guess you can talk from any angle you want to in terms of a person who is buying hard assets or somebody who's being a passive investor. What sort of early on, what mistakes did you encounter? Things that you have since learned is something you're going to avoid like the plague now.
Bill, I was very lucky that a lot of mistakes I learned were at somebody else's expense, number one. And number two, I've been privileged enough, and I say this with the utmost humility, that I've been privileged enough to live through two major recessions at a very early age. So one was 2008, when I was barely getting started. So I had nothing to lose personally, right? Versus people say were 55 and lost their life savings, essentially. And then the oil and gas crisis in 2014, again, relatively young, early in my career. So you can't lose if you don't have a lot to begin with, right?
Right.
So for me, one thing I had learned over a period of time, actually, I still remember this. I'm going to give you a good idea and that can show you my investment philosophy. We knew a lot of folks, basically, when the city is rezoning, when the city is expanding and they're rezoning,
Yes.
So a lot of farmland outside of your city gets rezoned as commercial or residential. Right? So we knew a lot of families whose farmlands had basically been zoned as commercial. So overnight, they became millionaires. I'm talking like serious money, right?
Wow.
So the problem with easy money is that it comes easy and it goes easy as well. Right? So even though that they became like weirdly rich overnight, what I saw was, these people started doing really stupid things. They started buying flashy cars, moving into houses they couldn't afford, spending money like it was going out of style. Right? And I remember as a kid just asking him, I was like, dude, why don't we go spend more money? Why don't we do that? Why don't we have a nice car? We can afford it. And he's like, look, man, everybody has their own money. They can do whatever they want. This is what we have chosen to do with our money because we feel it's a safer, better bet for long-term sort of success, right, for our family. And for those 2 years when I was a kid, I was like, oh, man, our neighbor has a way better car. Right? Well, it turns out 3 years later, the guy's bankrupt.
No
right?
way.
And 3 years later, I kept sulking for those 3 years. And 3 years later, at a younger age, I was like, all right, he really did not afford that house. Okay, now I know. So it was an early lesson in learning that you always have to be kind of cautious. You always kind of have to live modestly below your means at all times. You can never be too flashy. And you should always have ample liquidity on hand.
That's great. That's a great message. Yeah. I think that's, that kind of sounds like a show you probably don't even know. It's called Beverly Hillbillies. And it was a guy that, this poor guy that lived out in, I don't know, in the backwoods and discovered oil on his property. And, overnight, there was this, he's just like living in a mansion in Beverly Hills. It was an old show from the 60s. But anyway, it's that idea of, when you do, obtain that money, it's making it sustainable, right?
Yeah, exactly.
And that's why, we talk a lot about cash flow here, is getting cash flowing, assets that are constantly producing for you. Where you really don't have to do anything because it can kind of do it on their own. Granted, you have to manage it, but that idea. And, the great thing about multifamily is not only is it cash flow, but then it also increases in value over time too. So you've got this, it's not like just getting this big lump sum. It's really something that if you manage it properly, it can be something you can hand down from generation to generation, which you experience in your own family, I'm sure,
Yeah. And look, to be honest with you, Bill, as somebody who belongs to a business entrepreneurial family, look, if anybody's doing business for any period of time, they're going to have ups and downs, right? That's just the nature of the beast, right? So, when the going is good, you shouldn't confuse good luck with skill.
That's
great. Because everybody looks like a genius in a bull market.
I love that. Yeah, that to me is a great. I mean, just a I don't know. It's just kind of a great quote to be able to look at in terms of how we are viewing even this period now. I don't know how long you've been actively doing the multifamily, but even in multifamily, there was, maybe 5 years ago, there was a whole different way to buy, and people were doing the 3 to 5 year holds and doing, just the whole approach was different. Well, it's changing, and it has changed recently, and a lot of those assets that were very easy to obtain, even under market, aren't there anymore because you've got international institutional people coming in and paying over asking price for them. So you could have your plan set out. Oh, I'm going to be doing the 3 to 5 holds and the value add and blah blah blah. It's a different market today. It really is.
Bill, Mike Tyson, the eminent philosopher of our time, right? Mike Tyson has a great saying. He's like, everybody's got a plan till you get punched in the face.
I like that. You've got some great quotes. You should put a little book together,
Hey, I'm just riffing off of Mike Tyson.
Well, it's true. It's true. But, one thing that is a little bit interesting, too, is that as we approach, a changing economy here, and we don't know what that's going to look like, right? We don't know how severe it's going to be, or what it could be very mild. It could be devastating. I'm sure in terms of the assets that you're investing in now, you have to be looking at that, right? I mean, in terms
we look at it every day, Bill. Like the two things you can never change are demographics and location. Mm-hmm. So ideally for us, we're actually even looking at assets where we make less returns, but they are better located, in better markets, more mature sub-markets. They're better located from a transportation, retail, all that point of view, and take slightly less return on that. Because, Bill, I think the one thing people don't realize is that any return a sponsor shows you, first of all, that's just what their crystal ball is saying right now.
Mm-hmm. Yeah.
That's not a guarantee for the future.
Right.
So sometimes it's actually better to take a lower return asset with an assurity of getting that return, or as close to an assurity as you can reasonably get, right? As opposed to just, shooting for the moon and then just kind of losing all your money.
Are you looking more long-term than you were in the past?
Well, it depends on the asset, right? For instance, there's some assets, we're just doing a deal in Jacksonville where it is such an underperforming asset in one of the fastest growing submarkets in Jacksonville that literally all we have to do, we don't even have to come do anything fancy, okay? Literally, if we just bring the rents to market, that's it. Wow. We're going to make our money.
Wow.
But hold on, but that took me like 12 months to get that deal also. Right? Wow. So for some of the more mature, stabilized assets, that are just at market, that are doing good, but we know they're well positioned, there's a lot of development going around. For those types of assets, we're totally doing 7, 10, 12-year holds.
Right. What do you say that you're doing right now as a company in your own personal approach? What are you doing now that is something that you feel has really been really key in your success and the growth that you guys have experienced?
Bill, I think the key in my success has been that the fact that we've been diligently building our network out, and we've been diligently doing all the stuff that we said we were going to do, and then we followed up and did all that stuff. So a lot of times, as much as it pains me to say this because my mom told me this and I was like, no, I'm not going to believe you. As much as it pains me to say this, a lot of things in life are a factor of time. If people see you diligently working, they see you consistently doing the same thing, they're more apt to work with you, right? Because they see consistency of effort. A lot of people are a flash in the pan. So we purposefully decided when we were doing this to not be a flash in the pan, to do the stuff that, for instance, we would do at the institutional level, but with a different type of client. So because we're doing all of that, and we've been doing it, our broker relationships are improving, our investor database is improving. We're talking to more intelligent folks like yourself on a daily basis, right, to improve our knowledge.
God,
but that's a factor of time. I mean, no matter what I did, I couldn't accelerate that pace.
So it's really having a commitment to excellence and sticking with that for the long term. I mean, it sounds like your company you want to grow it and see some good things happen for the long term. So that's great.
Oh yeah. And I'll give you an example. I mean, when I started out, I knew a lot of my friends in investment banking and private equity making a lot of serious money. And the first deal I was doing, I got no love, Bill. I mean, I had to grind my investors out one at a time. And I was like, dude, you have so much money. I know you tell me about this all the time. But you know what happened? I was busy with my second or third deal, so I didn't send out my newsletters, right? And then you would not believe it. I got like 6 or 8 messages from really big investors, right? Hey, I hope you haven't unsubscribed me from your list. I was just busy with other projects. I'd love to invest in your next deal, because they kept seeing consistency of effort. They kept seeing doing that thing, right? So my point is, as long as you keep doing the right things, things eventually work out.
Yeah, and I think when you do it right like that too, you really don't have to look for investors, because the folks that you have not only reinvest with you, but the word of mouth gets out there, and you get other people that have the same expectations, and you end up with a real solid investor base. That that's awesome. Well, I do want to talk about the analysis part. And I think that that's really important. And I'm really also very interested in sort of this time in space here, so to speak, in what's happening economically and so forth. What can you tell me in terms of how you're underwriting deals today? What key elements there are factors that you're finding, just from firsthand experience, as well as you're projecting for the future, are some of the most important factors, and how are you underwriting some of these major deals?
Okay, so with the caveat being that I do not have a crystal ball, with that caveat in place, what we're seeing across the board, even in really hot markets like Dallas, for instance. I'm not investing in Dallas, even though I think it's a fantastic place to live and raise your family and all that jazz, right? I mean, I live here. For instance, what we're seeing is, even in really hot markets like Dallas, the pace of rent growth has considerably slowed, number one. So earlier, when, you could really just pull a number out of your hat and be like, all right, 5%. And I mean, you totally made up their number, but the market kind of bailed you out, right? Mm-hmm. Yeah, that's not working anymore. Number one, you can't just exponentially keep growing rents forever, because trees don't grow to the sky. Number two, what you're seeing coincidentally with this is, because we're actually in a very hot, actually a good economy, right? I mean, unemployment is at all-time lows, all that stuff. What's actually happening is that the pace of expense growth is increasing than what typically people would put at 2%, the rate of inflation. Now it's 2.5, 3%, depending on where you are. And then what we're also seeing on exit is that your exit cap, the amount of basis points you've got to add at the minimum to your purchase cap to kind of be, conservative, right? Yeah, that's got to increase. A lot of guys are trying to get away with putting like 30, 40, 50 basis points. And look, it might work. I'm not saying I don't have a crystal ball, but it's better to start, if you're looking at B and C type assets, to start looking at an exit cap 75, 125, 150 basis points higher than your entry point, just to temper down sort of expectations. And look, the way I look at it is, nobody's going to have a problem if you give them more money. Okay? Mm-hmm. But people are going to have a problem if you say you're going to return 16% and you return 15.5. Now, if you think about it, that's not a big difference, but you promised one thing and you delivered something else. Right? So you have to temper down. You have to take down the temperature of the room, cool it down, try to explain to people what you're doing. And look, a lot of people might be like, well, I'm not going to do it. And that's fine. It's better that person goes and comes back and then is a convert forever than for you to take somebody's money and then they're annoyed at you for the rest of their lives.
Right. What about debt service? How are you treating debt service in your deals?
Across the board, a lot of deals are debt service constrained right now. So if you're going the agency route, you're looking at low to mid 60s, maybe, if it's a really nice deal, maybe all the way up to 68%, 69%. But a lot of deals are debt service constrained. So you can have a really good deal at, say, whatever terms, significantly higher than the agency terms, and that would work. But if you're going the agency route, you just can't get it. I mean, it's just not going to work. So you are debt service constrained. So even for good assets, people are trying to sell it, but the price that sellers expect versus the price that the lenders are going to lend at are wildly divergent.
So how do you deal with that? What's your approach with the owner, expecting this amount, and at the same time, it's not realistic from a lending side?
Well, Bill, you can't expect me to give away all my secrets.
Oh, come on. That's why we have you on the show here. There's only, I don't know how many thousands of people listening, but you're just sharing it with a few close friends. Come on, we're old dogs. Okay. We'll even make you an honorary old dog, okay?
I'll tell you the secret the elites don't want you to know, Bill.
Okay, we love it.
Okay, well, Bill, the secret is there is no secret, Bill. You got to work with what you got. right? So earlier, if we were looking at 30, 50 deals before we kind of, got a deal, now we're looking at 100, 120 deals. I mean, that's just the way it is. It's becoming a numbers game now. And coincidentally, on the other side, look, if you've got to work with lenders, my best advice to you would be anytime a lender gives you terms, even if you think they're great terms, just say no. No, those are complete BS terms. I want to go line item by line item. But then you better have a good reason which line item you want them to be lenient on, right? So if you can't just make up something, like you better have the knowledge, you better have a good reason. For instance, I'll give you an example. One of the assets we're going to buy, the payroll was at some weirdly high number, right? And that was because a lot of costs it was owned by a private equity firm, so they were just offloading a lot of costs to this. So the lender was underwriting at the T12 cost. And I had to sit down with the lender and tell the guys, like, look, dude, the sub-market average is $200 to $300 below this, okay? So just because the current owner is acting stupid or offloading costs, whatever, because they could be very smart and they are smart, doesn't mean you have to underwrite at that. So as soon as he takes $200 or $300 out from there, he does $50 or $100 adjustment in utilities, then you add, say, 5 to 10% in RUBS. When you go through all this kind of stuff, suddenly you start looking at a very different picture. And guys, the deal is, when the lender says no to you, it's not like they're saying no to you. This is their business. If they don't give out loans, the guy doesn't make his bonus. He wants to give you a loan, but he also wants to cover his backside, right? Because what you don't want is a career risk. You don't want to give somebody a loan, 6 months later they default, and then who do you think they're going to come to? They're going to come to the loan originator. Hey, why did you do this? And then you have to explain all this stuff, and nobody wants to go through that. So if you work with the lenders, you know what you're talking about, you've got good reasons, you can find a way. Now, is it going to be easy? Probably not, but at least you can start getting better terms.
I like that. And what line items are key for you as you go down
that depends on the asset, Bill, right? For instance, in some underperforming assets, your payroll could be really high. Or, for instance, your utilities could be really high. In some of the older vintages, right? Utilities are really high, especially if the owner hasn't done low-flow toilets and plumbing and all that kind of stuff, right? Or like those LED lights, if you haven't put them on, so your utility bills could be really high. Then, for instance, a lot of owners might not be billing back as much as they could. So they might not be getting as much credit on the RUB side, right? So they're not doing that. Then, for instance, maybe they're not maxing out their rent. So maybe rents are 10, 15, 20% below market, right? I mean, there's got to be a story there, right? Why are you buying this asset? You're probably buying this asset because rents are below market. The owner has egregiously high expenses or some shape or form, something along those lines, right? So you're presenting a story to your equity investors. Similarly, you have to present a story and walk people from the lending side. You have to walk people through your vision. And now, will they agree with your vision? Probably not. But hey, you got to take your best shot.
I like it. Great advice. Hey, thanks for breaking the code here and sharing some inside information.
Just make sure you don't tell other people.
Yeah, no, it's just between me, you, and whoever may be listening. Okay. Yeah. Well, Omar, we have an audience that. Although a lot of people listen from all ages, we really do focus in on those 50-plussers, people that are approaching retirement or already in retirement. And these are people where their nest egg is really, really important to them right now. Those that are approaching it are, there may be concerns that, it may not be enough to be able to carry them through the long haul in their retirement.
The golden years.
Yeah, right. And then you got those that are already in there and they're kind of experiencing firsthand, hey, I need more cash flow here. And so what advice would you have to those folks that are considering real estate investing as a means to kind of solve that gap that they're seeking to fill?
So I can put my CFA hat on because that's all I did as a CFA charter holder, portfolio management institutionally, right? Guys, as much as it hurts my business and to say this, not everybody should be as heavily invested in real estate because in your retirement age, you have to there's two basic things that you're looking for, right? Actually, three things. Number one is you cannot make as much of a mistake as, say, I can at 33, 34 years old because I have more time to recover from my mistakes, right? Number one. Number two, most retirees or people nearing retirement, they have to manage two or three things. Assuming, the big ticket items are taken care of. Hopefully, they're not getting a divorce. They don't have to pay or have paid for their kids' college education and weddings. Those sorts of items, right? They're done with that, right? The problem that a lot of people have is that they have to manage today's income or liquidity today with long-term growth of their assets. So what you don't want is this thing called a longevity risk. Longevity risk basically means that because we are living longer now, right? The problem isn't that we don't have enough money compared to our earlier generations. The problem is we're just living too long. So now that $2 million earlier might have had to last for 10 years. Now it's got to last for 25. So we've got to discover we can't just be doing that simple, fixed income, bond sort of allocation, just put money in small little things. Now, because you have a longer time horizon, by definition, you can take a longer term view. So for instance, you can invest in a combination of real estate that's both capital appreciation heavy, well located sort of assets, but also coincidentally, you can also be investing in cash flowing assets. Right? Because earlier the mantra was, look, you're retiring, all you need is cash flowing assets. But the problem with a lot of high cash flowing assets, like a lot of high risk bonds, high dividend yield stocks, the problem is that their growth potential isn't very high. Something is cash flowing more because a lot of really nice, well-positioned assets, say for instance, an asset on Fifth Avenue or Park Avenue, New York, right? Over a 10-year period, you're probably going to be better off than if you bought an asset in Mississippi. That's just the way it is. Mm-hmm. Right? I mean, that's just location, right? So as a retiree who's got hopefully a long-term life horizon, right, you can afford taking more risk than you're thinking right now, just sheerly based on the fact that you have more years to live. So you have to start thinking in terms of those sorts of things. And my combination, because look, my parents are in this age as well, and my dad worked on the portfolio management side, so he's a lot more sophisticated at it. The idea that you just have to look only for cash flow in your retirement years, I think that's just not right from a portfolio management perspective. You have, as a retiree, you have to start focusing on the long-term picture. You have to start making sure that you're allocating a chunk of your money in growth stocks, growth sort of real estate, growth opportunities. Because it's not just the pile of money you're trying to save, you're trying to grow that pile of money. Because costs are only going up, guys. Costs to finance your life, healthcare costs, all these costs, they're only going up. And they're not going up at the rate of inflation.
Great information, good advice. Well, looking at your company that you are very active in, obviously, and Boardwalk Wealth, what's sort of the plan? What's the future for you, your company, and what are you excited about for the future of Boardwalk Wealth?
Well, look, we're always excited. I can give you the boilerplate answer. We're excited to grow. Our investor list is growing. We can do more deals, all that stuff. But from a personal point of view, what I'm also excited, Bill, is that now that I have a 1-year-old son, right? I'm very excited to be in a position where hopefully over the next few years that I can design a life where I'm not just, I'm not doing the typical 9 to 5 or 9 to 9 sort of work hours, right? Where I can work when I have to work, but I can also take a lot of time to go to my kids' ball games. I can take time to spend more time with my kids, all that sort of stuff. And I was very privileged that my family was in a position growing up that my father could do that. And I knew not everybody could do that, right? So I'm very grateful for that. So I'm very excited about, from a personal perspective, that the business is offering me an opportunity that I can actually spend time with my son, as opposed to, kind of spending time with him, but not really personal time, like actually developing a personal bond with him.
Right.
And devoting more time to my wife as well, right? Like not just a, hey, what's up, dinner, and like, okay, we take our 2-week vacation in the year and we're kind of done, right? But actually spending time, trying to grow as individuals also, right? Because I think with my son being born and now I've been married for 3 years, I hope, although my wife might disagree with me, that my personality is rounding out. Mm-hmm. Right? I mean, I'm becoming more very not like numbers driven, and also like, I'm trying to develop myself. So I'm excited for those sort of possibilities also.
That's great. It sounds like you've got your priorities in the right place. That's exciting, Omar. Wow. Well, gosh, we are kind of nearing the end of our discussion here. It's a shame because I could probably pick your mind for the next couple hours here. But we're going to stay in contact and hopefully have you back again. I'd love to be able to pursue some of these areas we've touched on a little bit here. But we're at our portion we call our wrap it up session, and that's where I know it's kind of our lightning round type thing where we ask you a series of quick questions and just try to get some great resources that you're involved with and that you can recommend to others. So if you are ready, we can move in and wrap it up.
That's a lot of pressure, Bill. I hope I'm ready.
Oh, you can handle it. I know you can handle it. All right. First question. Favorite real estate book?
Oh, I'm actually reading this one right now. It's The Real Estate Game by William Porwu.
Oh, good. This is one I haven't heard of. So
He's actually, I think he was heading the real estate department in Harvard, but he was also like an actual real estate developer. He wasn't like just an academic in an ivory tower.
Oh, I like that. All right, favorite just general business book.
Oh yeah, I've got to go. I don't know if it's directly business book, but have you heard of The Black Swan, right? By Taleb,
Yes,
right?
I have.
Right.
Uh-huh.
I think that's a great book for business as well as life, because it kind of teaches you that you kind of, what's that saying by Mark Twain? Hold on. Mark Twain is one of my favorite authors, right? So Mark Twain, what you don't, hold on. Let me just type it in Google because I want to tell you that saying. So Mark Twain's got a great saying, right? The great saying is, it ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. Right? And Taleb is all about that, right?
It's more entertaining hearing you try to have an accent like Mark Twain that I'm enjoying. Okay, go ahead.
So I love Taleb's book Black Swan. I think it's a good primer on life. Just life, manage your risk, don't go overboard, and learn to realize that life has a way of putting you in its place if you try to become too big for your britches.
That's great. I love it. How about most valuable website for success, other than your own, of course?
Oh, well, I was going to say Boardwalk Wealth, but apart from that, I think the most valuable website in the entire world for me is Google.
Okay. Yep.
Literally, but Bill, the one thing I've realized is I think I have not had an original idea in my entire life. Because I typed that into Google, I was like, oh my God, half of humanity has asked the same question before.
You just Google it, that's what I like to do. All right.
Yep.
Great. How about favorite app on your phone? Anything that you use that has really just been real helpful for you?
Oh, I can just look at my Slack. These days it's Slack, the messaging app.
Yeah, I've been hearing a lot about that one lately.
Oh, you should use it. I love it.
I haven't taken that. It's like one more thing I have to learn. I'm kind of going, I want to do it, but is it really going to save me the time that everybody says it does and all this stuff? So
it depends, right? It depends what you're doing. If you've got teams, then it's great. If you don't have teams, don't bother.
Yeah, that's good, right? Well, I don't have much of a team here, so probably I'll hold off. Okay, how about your favorite quote? You may have already said it. I don't know, but what is your favorite quote?
I don't know about that. Mark Twain has got such a great bunch of quotes that I would be doing a disservice. All I'm going to say is just type into Google, which I'm doing right now, Mark Twain, great quotes. Right? For instance, number one that showed up. If you tell the truth, you don't have to remember anything.
I love that one. That's one of my favorites.
Or hold on, this one, which I really like these days. Whenever you find yourself on the side of majority, it is time to reform or pause and reflect.
That's great. That's another good one. Wow. Okay, well, our final question in our wrap it up session. Here we go.
Yeah.
If, something cataclysmic happened, you lost everything. Your bank accounts are cleared out, everything. I mean, you may have a home you're living in, but all you really have is $1,000 in cash in your hand. Okay. What would you do with that $1,000 to relaunch your real estate investing business?
Oh, spend it all on marketing.
All on marketing, like specifically what kind of marketing?
Oh, specifically, for instance, I would react if, for instance, would I get access to my mailing list or no in this particular case?
Yeah, you could have your mailing list. And knowing everything that you know. I mean, you have all the knowledge you have, yeah.
Oh, yeah. Just give my money to my marketing guy, Sean. He's a good friend of mine, and develop a marketing campaign and just go from there. And
you definitely get a return with that 1,000.
Yeah. Way better than anything else.
That's great. Wow. I got to talk to your marketing guy. No, I'm just kidding.
Well, you should. He's a good guy.
All right. Maybe we'll have him on. I love it. Wow. Well, I'm sure there's a lot of folks here that are listening that would just like to know more about you and what you guys do, or maybe even want to contact you. What's the best way folks can find out about you, maybe reach you if you would so be available?
No, I thought you'd never ask, Bill. They can go to our website, Boardwalk Wealth, BOARD walkwealth.com. There's a form right on the front page which says your name, email address, how you found out about us. You can use that, and once you enter your information, you'll get an automated email saying, hey, just verify your information, right? Or you can email me directly, Omar, O-M-A-R, at boardwalkwealth.com.
Awesome. Well, Omar, this has been really great, and I have been actually really looking forward here to this last, closing area here, because you're not like I guess up in Canada, they have a lot of like howling dogs and stuff like that. Wolves, right? Yeah, and then now you're in Texas, and there's probably all kinds of hunting dogs around and things. Well, I don't know about Metro Dallas, but you never know. They could still be out there. So I think you're prepped, and I'm sure in Pakistan they probably had dogs.
I've actually gone all the way up to Himalayas, Bill. I've gone to the base camp of the K2, and all the way up there, there's a lot of weird howling going on, man.
Wow. Okay, so you've got just a much broader experience than most of our guests. Yeah. So we're really expecting something great here. If don't put a lot of pressure on me. Okay, I'm not a professional howler yet. Okay, all right. Well, you're working up to it here, but if you are ready, okay, Omar, you want to go ahead and close us out with your best howl here. Oh, that was good. That almost had
give me the award. Bill, you better give me the award now. I mean, just call it. Just finish everything. Give me the award right now.
I think that's definitely going to get into the at least into the consideration. For the great Golden Howl Award. So, Omar, that was great. Thank you. If I had an applause track, I would add it. Maybe our producer will put it in. We'll see what happens.
I think you should talk to your producer about putting it in.
Well, gosh, thank you so much for coming on, Omar. It's been a kick, and also it's been very informative. A lot of great stuff, a lot of great information.
Thank you, Bill. I really appreciate you hosting me today. Thank you.
Oh, it's my pleasure. And I also want to thank all our old dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we really appreciate it. Please note everything we discussed today will be on our website, okay, at olddogsreinetwork.com/blog. And there'll be links to all of the various things that have been mentioned here, as well as very detailed show notes. So look for the episode with Omar Khan. That is the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.